Most people spend 30 or 40 years working, saving, and doing their best to set themselves up for retirement. But when it comes to actually structuring that retirement, which accounts to use, how they work, and why each one matters, a lot of people are guessing. That's not a criticism. Nobody teaches this stuff in school. You're expected to figure it out on your own, usually while also holding down a job, raising a family, and dealing with everything else life throws at you. What tends to happen is people end up with one account, usually a 401k because work set it up automatically, and they assume that's the plan. And it's a start, but it's not a complete picture. The retirement system in the United States actually gives individuals access to several different accounts, each with its own tax advantages, its own rules, and its own specific role in a well-built retirement plan. Used together, they can significantly reduce how much you pay in taxes over your lifetime, give you flexibility about when and how you access your money, and help protect you against some of the biggest financial risks that come with aging, healthcare costs chief among them. Matt here, and today I want to walk through 5 of those accounts, not to overwhelm you, but to help you understand what each one does and why it exists, and make the whole picture a lot clearer. By the end, you'll have a better sense of where to focus depending on where you are right now. Let's find out. Account number 1, the 401k or 403b. Let's start with the one most people already know, the 401k. If you work for a nonprofit, a school, or a hospital, yours is probably called a 403b. Same idea, different name. Here's why this is the foundation of almost every retirement plan. When you contribute to a traditional 401k, that money comes out of your paycheck before taxes are applied. So if you're in the 22% tax bracket and you put in $10,000, you've reduced your taxable income by $10,000. That's a meaningful savings in the year you contribute, and the money grows tax-deferred until you withdraw it in retirement. The bigger benefit for a lot of people is the employer match. When your employer offers a 401k match, here's what that actually means. For every dollar you contribute up to a certain percentage of your salary, your employer puts in a matching dollar. A common structure is a 3% match. You contribute 3% of your salary, they contribute 3% of your salary. You've now invested 6% total, but only half of it came from your paycheck. The only condition is that you have to contribute first to unlock it. On contribution limits, in 2026, you can contribute up to $24,000 per year. If you're 50 or older, the IRS allows an extra $7,500 on top of that as a catch-up contribution, bringing your total to $31,500. If you feel behind on retirement savings, the catch-up provision exists specifically for you. The simple takeaway, at minimum, contribute enough to get your full employer match, then try to work up from there over time. Account number 2. The Roth IRA. If the 401k is the foundation, the Roth IRA is arguably the most underused tool in personal retirement planning. Here's the core idea. You contribute money you've already paid taxes on, it grows over the years, and when you withdraw it in retirement, the entire amount, growth included, is completely tax-free. Not tax-reduced, not tax-deferred, tax-free. In 2026, the contribution limit is $7,500 per year, or $8,600 if you're 50 or older. To contribute the full amount as a single filer, your income needs to be under $153,000. For married couples filing jointly, the limit is $242,000. Above those thresholds, the contribution limit starts to phase out. Now, $7,500 a year may not sound like a lot, but let's put it in perspective. If you're 40 years old and you contribute $7,500 annually at an average 8% return, which is actually below the S&P 500's historical average, by age 65, you'd have roughly $548,000, all of it tax-free when you pull it out. You paid taxes on the $7,500 going in. The growth, though, the IRS doesn't touch it. There are 2 other things about the Roth IRA that people often don't know. First, there are no required minimum distributions. With a 401k or traditional IRA, the government requires you to start taking withdrawals at age 73, whether you need the money or not. A Roth IRA has no such requirement. You can let it sit and grow for as long as you want or pass it on to your heirs. Second, you can withdraw your contributions, not earnings, just what you originally put in, at any time without penalty. This makes the Roth IRA slightly more flexible than most tax-advantaged accounts, though I'd encourage you to treat it as retirement money and let it grow. One more thing worth knowing, some employers now offer a Roth 401k option alongside the traditional. If you think you'll be in a higher tax bracket in retirement than you are now, the Roth version makes sense. If you think you'll be in a lower bracket, the traditional is probably better. And if your employer offers both, you can split contributions between them, which gives you tax flexibility later on. Account number 3, the Health Savings Account, or HSA. This one surprises people the most because most people think of the HSA as a healthcare account, not a retirement account. But when you understand how it works, it might be the most tax-efficient account available to any American worker. The HSA is the only account in the U.S. tax code that offers what's called a triple tax advantage. 1, contributions are tax-deductible, just like a traditional 401k. 2, the money grows tax-free inside the account. 3, withdrawals for qualified medical expenses are tax-free at any age. That's 3 separate tax benefits in a single account. No other account does all 3. To be eligible, you need to be enrolled in a high-deductible health plan, or HDHP. In 2026, the contribution limits are $4,450 for individuals and $8,750 for families per year. There's an extra $1,000 catch-up contribution available if you're 55 or older. Now, here's how to use this strategically for retirement. Most people contribute to their HSA and then immediately use the funds to pay medical bills. That's a fine use of it, but it misses the bigger opportunity. Here's how. When you use your HSA to pay a $200 doctor's bill today, that $200 is gone. It did its job, it covered the expense tax-free, but it stops there. The story ends at $200. When you leave that same $200 in the account and invest it instead, something different happens. That $200 starts growing. Over 20 years at an average 8% return, that single $200 contribution becomes roughly $930. And when you eventually withdraw it in retirement to cover medical expenses, none of that $930 gets taxed, not the original $200 and not the $730 in growth. So if you can't afford to pay your current healthcare costs out of pocket and leave the HSA money untouched and invested, you're building a dedicated tax-free fund for the healthcare expenses that nearly everyone faces in retirement. Healthcare is consistently one of the largest costs retirees deal with. Having a pool of money specifically set aside to cover those costs, growing tax-free over 20 or 30 years, is genuinely valuable. There's also an important rule to know. After age 65, you can withdraw HSA funds for any expense, not just medical ones. You'll pay ordinary income tax on non-medical withdrawals, the same as you would with a 401k, but for medical expenses, it remains tax-free forever. The practical move? If your employer offers an HDHP, compare it seriously against your other plan options. If the HSA math works out, invest those contributions rather than spending them and let the account grow. Account number 4, the Traditional IRA or SEP-IRA. Account 4 is one that often gets overlooked because it seems redundant. It's another IRA, and most people already know about the Roth. But the Traditional IRA and its cousin, the SEP-IRA, serve specific and important purposes depending on your situation. Let's start with the Traditional IRA. Like the 401k, you contribute pre-tax money, it grows tax-deferred, and you pay income tax on withdrawals in retirement. The contribution limit is the same as the Roth, $7,500 in 2026 or $8,600 if you're 50 or older. This account tends to be most useful in 3 scenarios. First, if your employer doesn't offer a 401k. If you're part-time, self-employed, or just work somewhere without a plan, the Traditional IRA becomes your primary tax-deferred vehicle. Second, if you've already maxed out your 401k and want more tax-deferred space before putting money into a taxable account. Third, as the starting point for what's known as a Roth IRA conversion strategy. If your income is above the Roth IRA contribution threshold, you can contribute to a Traditional IRA and then convert it to a Roth. There are tax considerations involved, and it's worth talking through with a financial advisor or CPA before doing it, but it's a legitimate strategy that many higher earners use. Now, for anyone who is self-employed, freelancers, contractors, business owners, I want to make sure you know about the SEP-IRA specifically. SEP stands for Simplified Employee Pension. The contribution limit is dramatically higher than a standard IRA.
In 2026, you can contribute up to 25% of your net self-employment income with a maximum of $75,000. All of it is tax deductible. If you run your own business and aren't using an SEP-IRA, you're likely overpaying taxes while underinvesting for retirement at the same time. It's one of the most straightforward tools available to self-employed people, and it doesn't require a lot of administrative setup. The simple takeaway? The traditional IRA fills the gaps in your plan. The SEP-IRA is essential if you work for yourself. Account 5, the taxable brokerage account. Account 5 is the one people sometimes push back on because it doesn't have the tax advantages of the others, and that's fair. There's no upfront deduction, and you'll pay capital gains taxes on profits. But here's why it belongs in a retirement plan anyway: flexibility. Every tax-advantaged account comes with rules: contribution limits, income restrictions, age requirements for withdrawals. The taxable brokerage account has none of those. There are no contribution limits. You can put in as much as you want, whenever you want. There are no required minimum distributions, and there are no penalties for withdrawing before age 59 and a half, which makes this account critical for anyone who wants to retire early or needs access to funds before the traditional retirement age. On taxes, yes, you'll pay capital gains tax on investment gains, but long-term capital gains rates for investments held over a year are significantly lower than ordinary income rates. For married couples earning under $96,700 in 2026, the long-term capital gains rate is 0. And strategies like tax loss harvesting, selling positions at a loss to offset taxable gains, can further reduce the annual tax impact. Think of the brokerage account as the flexible layer of your retirement plan. It's where money goes once your tax-advantaged accounts are maxed out. It's what bridges the gap if you retire before 59 and a half and need income before your other accounts are penalty-free. It's also the account with the fewest constraints, which in retirement can be more valuable than people expect. Now that we've covered each account individually, here's how to think about them as a system. The order most financial planners recommend goes something like this. Start with your 401k and contribute at least enough to capture the full employer match. That's the floor. Don't go below it. Next, if you're eligible for an HSA, fund that. The triple tax advantage makes it one of the most efficient places to put money. After that, max out your Roth IRA. Tax-free growth over a long period is hard to beat. Then go back to your 401k and contribute up to the annual maximum if your budget allows. If you're self-employed, layer in the SEP-IRA. If you need additional tax-deferred space beyond that, the traditional IRA can fill the gap. And once everything above is handled, the taxable brokerage account absorbs the rest. In retirement, the real benefit of having all 5 is that you get to choose where your income comes from each year based on your tax situation. High income year, pull from the Roth, where withdrawals are tax-free. Low income year, draw from the 401k, where you'll be taxed at a lower rate. Medical expenses, use the HSA. Need liquidity without penalty? The brokerage account is there. That's not just wealth, that's tax flexibility. And over a 20 or 30-year retirement, having options about how and when you're taxed can be worth hundreds of thousands of dollars. One last thing worth saying. You don't have to have all 5 of these accounts running perfectly to be in good shape. Retirement planning is not an all-or-nothing exercise. Every account you open, every dollar you contribute, and every year you let that money grow is progress. The goal isn't perfection. It's building a system that works for your situation and improving it over time. Start with what you have access to right now. Get the employer match, open the Roth IRA, add the HSA if you're eligible, then keep building. Small, consistent steps taken over years produce results that are genuinely hard to believe when you look back. None of this is complicated. Most people never get a clear explanation of how these accounts work together, and they end up in retirement with more taxes, less flexibility, and fewer options than they needed to have. If this was helpful, leave a comment below. Which of these accounts do you already have, and which one are you opening next? And if you have questions about any of them, ask. I'll see you in the next one.